Good morning, everybody. It's Monday, December 9th, 2024. I'm Herb Morgan, Senior Managing Director, Chief Investment Officer at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly market and economic commentary for the week beginning today. As a reminder, if I've got something to say or something happens intra-week, I'll put it up on either LinkedIn, be sure to follow me there, Herb Morgan, or on X at Herb W. Morgan. With that, let's get into it. As a reminder, everything you're seeing and or hearing is developed by us for use with either investors or financial advisors. There's nothing in the presentation that is tax advice. There are no recommendation for the purchase or sale of securities. Everything is for informational purposes only. The views expressed herein are mine and mine alone, may differ from the views of our parent company, any affiliates, or other portfolio managers at the firm. We had a mixed week in equity prices. As you can see, large cap stocks is identified by the S&P 500 and extremely identified by technology these days, up about 1%, while mid and small cap stocks took a breather and gave some back. Regardless of where you've been all year, you're in the double digits there domestically, looking very, very, very strong. International markets were strong last week, 1.7, led by emerging markets, up 2.5%, as continued capital flows into China on stimulus hopes take place. We also had the interest rates give up a little bit last week, and the 10-year Treasury got below 420 on the week. The aggregate bond index rose almost 0.5%. High yield, which correlates both with fixed income and with stock markets, up almost 9% on the year, had a good week last week as well. Moving along, a lot of economic data that last week. We got the PMIs across the board, 2 manufacturing PMIs, 2 services PMIs, and of course a lot of data on the labor market. Starting with S&P Global, U.S. manufacturing PMI, line of delineation as always is 50. Got really close, 49.7. It exceeded expectations, was the highest reading since June. And new orders, which are an indicator of the likely direction of the manufacturing sector, came in at 49.3. That's still contraction, but it is just easily could have slipped into expansion, and maybe it bodes well for the coming months. You can see the trough there and then coming out. Manufacturing is about 15% of the U.S. economy. The ISM manufacturing number, just a competing economic indicator, rose from 46.5 to 48.4. So a similar pattern here of sort of coming out of the doldrums. But ISM, it's been more than 2 years below the 50 reading here. So we've been in a real recession for manufacturing, according to this indicator. But you can see new orders, which is a sub-reading, 50, that's above. So that suggests stronger growth ahead, and production rising as well, although not quite as strongly. Moving on to services, bigger part of the economy. Great reading there, the highest reading from S&P Global since March of 2022, and I think almost more importantly, there was this sub-reading on prices charged. Prices charged, they still went up, but at 51, it was the lowest reading in about 4.5 years. So that bodes well for the CPI and PPI, especially the PPI number that we're expecting later this week. The ISM reading of services also above 50, though not as strong, and fell from the prior reading from 56 down to 52.1. It disappointed, but it's above 50. So the services sector continues to expand, and in fact, that lower level of expansion might also be helpful in the battle against inflation. Everything above 50, new orders 53.7, business activity 53.7, and employment at 51.5. Construction spending for the month of October up 0.4. That's double the expected gain of 0.2, and 4 times the 1/10 gain in the month of September. Another surprise strong reading last month was from auto sales. Auto sales, 16, let's call it 17 million for the better part of 6, 7, 8 years to shut down from COVID, a little bit of recovery, and then just haven't gotten back. It's the one industry that just hasn't gotten back. We've talked about in the past the reasons why. People don't want to learn technology, higher interest rates for financing, The durability of current cars, they last longer and do better, especially if we maintain them. But here we got to spike up. We got to 16.5 million annualized in November. We haven't had a reading there in 4 years. So that was a welcome bit of data for the nation's auto manufacturers. Factory orders rose 0.2, right in line with expectations, backing out transportation. All again, this is month of October, up 0.1. Moving on to the trade deficit. Remember, deficits, the formula for GDP is C, consumption, plus I, investment, plus G, government spending, plus exports minus imports. Every time you import a dollar's worth of goods, it subtracts from the GDP. The trade deficit did fall, though, from a 2-year high of about 84 billion to about 74 billion. Imports down 4%, exports down 1.6. It was across all categories, and it was welcome, but we still have a very large trade deficit. This is certainly an important item to the president-elect and the team and the administrative team that he's got coming in. The JOLTS report, or job openings report, for the month of October had a little surprise reading higher, went from 7.4 to 7.8, and the estimate was 7.5. So hard to see here, but it's a little tick higher on this. Now we're back on this trend line coming out of, obviously, the global financial crisis. We got the COVID, the recovery from COVID, and now we're sort of back to that where we would have been without the COVID issues. It was all about jobs last week, not just the JOLTS report, but the weekly claims for unemployment. They rose a little bit, 215 to 224, continuing claims at 1.9. This is a sign of a very healthy and robust labor market. Then we got the two national reports for the month of November, starting with ADP. They said, based on their statistical analysis, payrolls grew 146,000. That follows a gain of 184 in October, but that was revised down from the initially reported 233. Broad-based across the economy, but little emphasis on education, healthcare, and construction. The Bureau of Labor Statistics non-farm payrolls report said that we added 227. Unemployment rate rose from 4.1 to 4.2. That was interesting because you said, oh, that's 227 is good. I think some folks were expected to be better. Remember, we had a tough October at 36,000, hurricanes, dock worker strikes, etc. They were expecting the rebound to actually be a little higher. This is in a way good news because labor is such a major contributor to the inflationary situation. The services sector, the biggest part of our economy, is the biggest contributor to the inflationary situation as well. And if it's seen that labor is softening without collapsing, that would help the Fed achieve that soft landing of getting those inflationary numbers down. So even though we didn't get CPI numbers this week or PPI numbers, they're coming up in the week ahead. Even though we didn't get those in the data last week, there's a lot of sort of side information or anecdotal information to suggest that we might get a little more progress on the inflation side. We hope we will, of course. We also got Michigan consumer sentiment. You can see slowly creeping up here, up and to the right. Rose from 72 to 74. Estimate was 73. Current conditions, that's a big spike from 64 to 78. And expectations, though, fell a little bit. So we got some, I'd call it resistance here at this 80 level, but we really want to be back at this 100 level where we were prior to COVID. Economy was strong, people were feeling good. We're in the right direction, but we're still not certainly back to where we were prior to that whole situation. No major economic data today on Monday. We've got some good earnings reports after the close today. Oracle matters a lot. We've got Adobe on the 11th along with Costco. And I think Broadcom, right? I think Broadcom's coming later this week. Tomorrow, Tuesday, non-farm productivity, labor costs, business optimism. But really what matters this week, Wednesday, you see it here, CPI. That's a big one. And PPI. And remember my comments about some of the data that we looked at last week suggests perhaps maybe we could get some beats. If we got beats here, I think you could see a rally, a little short equity rally, short-term equity rally, as people think that maybe the Fed's making some more progress, which would give them a clearer path to cutting rates again at their December 18th meeting. Import-export prices on Friday. As always, thanks for tuning in. You can hear us on any of the podcast locations, but the best place to get me is on the YouTube, Slaying Bulls and Bears. I try to make the complex and complicated as simple and sensical. Please thumbs up, like, tell a friend, all that good stuff. Thanks, everybody. I'll be back to you again in 1 week.